Welcome to the deep dive. Today we're really getting into an iconic American brand, John Deere.
That's right.
A company that's, well, it's not just a giant in agriculture, but it's also navigating some really fascinating, sometimes tricky transformations right now. You see those green and yellow machines everywhere, right? Dominating fields. You might just think, okay, pure dominance.
Sure, that's the image.
But honestly, there's a much more complex story here. Innovation, yes, a powerful legacy, definitely, but also some surprising friction points just beneath the surface.
And that's exactly what we want to unpack today in this deep dive. We're aiming for a really thorough analysis of Deere & Company.
Yeah.
We'll look at the core business, those big competitive advantages they have, their financial picture, and importantly, some of these challenges that could genuinely change their path forward.
And we really have dug into a lot of different sources here, everything from, detailed investment research to what actual customers and employees are saying on forums online.
Ground level stuff, too.
Exactly. Our goal is to kind of sift through all that noise and pull out the key insights, giving you a real shortcut to understanding what's going on with this massive company.
So you're truly informed.
Right. So with that laid out, let's start with the basics. Those green and yellow machines are famous, but how does Deere actually make its money? What are the moving parts?
Okay, so Deere basically organizes itself into four main business areas. The biggest one, and you could argue the most important strategically, is Production and Precision Agriculture, or PPA.
PPA, got it.
Yeah, that's your large and mid-sized farm gear combines, big tractors, plus all the advanced tech solutions for those large-scale farming operations. It's huge, nearly 40% of their revenue in fiscal 24.
Wow.
And it's really where their whole tech-driven future, this big transformation they're pushing, is centered.
Okay, so PPA is the core. What else?
Then you've got small agriculture and turf. Think smaller tractors, lawnmowers, equipment for golf courses, that sort of thing.
Mm-hmm.
Still significant.
Right, the stuff you might see more around town.
Exactly. Then there's construction and forestry. This is heavy machinery, earth movers, logging equipment. They really bulked this up when they bought the Wirtgen Group a few years back.
I remember that acquisition. Big deal.
It was. And finally, you have financial services. This is their own bank, essentially.
Uh-huh.
They provide the financing for customers buying or leasing equipment. It's crucial for sales. And, it also helps smooth things out a bit when equipment sales have their cyclical dips.
Okay, that makes sense. So we know what they sell. But why has this business model been so durable? What's the fundamental thing keeping them going strong for so long?
Well, the key thing to grasp, I think, is that Deere serves a need that just doesn't go away. Producing food.
Right, it's non-negotiable.
Exactly. It's non-discretionary. That creates this incredibly strong, almost recession-resistant base demand for what they do. And layered on top of that are these really powerful long-term trends pushing demand even higher.
Like what?
Well, first, just more people on the planet. Global population's heading towards, 9.7 billion by 2050?
Yeah, that's a huge number.
And estimates suggest we'll need something like 47% more agricultural output compared to 2011 just to feed everyone. 47%.
Wow. So more food needed.
More food needed. Second, you've got rising incomes globally, particularly in developing countries. As people earn more, their diets change. They want more protein, more calories, richer foods.
Which it takes more resources to produce.
Precisely. More grain for feed, more land, more everything. And third, and this is critical, all this has to happen with resources that are either fixed or actually shrinking.
You mean like land and water?
Exactly.
Yeah.
Climate change impacts, water scarcity, limited good farmland. It puts immense pressure on farmers.
Yeah.
They have to get higher yields, be more efficient, basically do more with less.
Okay, so those are some massive tailwinds. How is Deere actually positioning itself to, ride those waves and meet those challenges? What's the strategy?
So Deere's response is what they call their smart industrial operating model and their leap ambitions. It's a really ambitious strategic shift. They're moving away from just selling you a tractor, a standalone machine, towards providing these integrated tech-heavy solutions.
So like services on top of the hardware?
Kinda, yeah.
Yeah.
Think of them almost trying to become a software and data company that just happens to also build heavy equipment. They're embedding this proprietary technology stack into everything.
Tech stack, like what specifically?
Things like high-precision GPS guidance, loads of sensors collecting data, all feeding into the John Deere Operations Center.
Ah, the cloud platform.
Exactly. That's their cloud hub for managing all the farm data. And they're pushing into autonomous operation too, self-driving tractors, essentially.
Right.
And the whole point is to change the relationship. It's not just a one-time sale anymore. It becomes this continuous, hopefully high-margin relationship built around data, software, and ongoing value.
And they have a specific target for that.
I do. They've publicly stated a goal to get 10% of their total revenue from these recurring sources by 2030.
10% recurring. That's a big shift for a company like Deere.
It absolutely is. The idea is to make the business less vulnerable to those historical boom and bust cycles in equipment sales. Make it more stable, more predictable, like a software business.
Okay, that makes sense strategically. Now let's talk about competition. Every great company needs a moat, right? That competitive advantage keeping rivals at bay. What's Deere's main fortress?
Deere's moat is, well, it's pretty formidable, built on two main pillars working together. First, intangible assets.
Okay.
This includes the John Deere brand itself. I mean, it's iconic, built up over almost 200 years. It stands for quality, reliability. People trust it. There's deep loyalty, often passed down through generations.
You see that, definitely. Farmers are loyal.
Very.
Okay.
And alongside the brand is their leadership in precision ag tech. They've invested heavily for decades. They have patents. They have know-how. That's hard to replicate.
So brand and tech know-how. What's the second pillar?
The second one is high switching costs. This is what makes it really hard for a farmer once they're in the Deere ecosystem to leave. A huge part of it is their dealer network. It's vast. It's generally very responsive. For a farmer, equipment uptime is everything. If your combine breaks down during harvest, you need parts and service now. Deere dealers are usually geared up for that.
Critical support.
Absolutely critical. And then there's the technology lock-in, which is talked about, especially the John Deere Operations Center. Farmers build up years of incredibly valuable data in there, yield maps, application rates, you name it.
And moving that data isn't easy.
It's difficult, potentially costly, and definitely risky. Would a competitor's system integrate seamlessly with the Deere equipment you still own? Maybe not. So you're kind of locked in by the data in the integrated system.
That sounds like a powerful moat indeed.
Yeah.
Can you maybe give us a concrete example? Walk us through what a farmer faces if they think about switching brands.
Yeah, absolutely. Let's take a big corn and soybean farmer. Their whole operation, planter, sprayer, combined, it's all John Deere, all connected through the operations center. Data flows seamlessly. Their local dealer probably uses JD Link, that's Deere's telematics system, to remotely monitor machine health. They might even call the farmer proactively, say, hey, looks like you might need maintenance soon, to prevent a breakdown during that critical narrow harvest window.
Active service, nice.
Exactly. Now, imagine a competitor comes along, offers a brand new combine, maybe 15% cheaper than the equivalent Deere model.
Seems tempting.
On the surface, yes. But the farmer has to think beyond that sticker price. First, retraining operators. New machines, different controls, different software interface. That takes time and effort.
Okay, training costs.
Then, data integration. How well will this new combine talk to their existing Deere planter and sprayer data in the operations center? Will it be seamless? Probably not perfectly. That's a headache and potentially lost optimization.
Right, the ecosystem is broken.
Potentially, yeah.
Yeah.
Then, the dealer network. Is the competitor's local dealer as responsive? Do they have the parts inventory? Can they guarantee uptime like the Deere dealer maybe can? That's a huge risk during harvest.
Yeah.
And finally, resale value. Farms often find that keeping a uniform fleet, all John Deere, holds its value better than a mixed fleet when it's time to trade in or sell.
Hadn't thought of that.
So you add up all those switching costs, retraining, data hassles, dealer risk, resale value, and suddenly that 15% discount doesn't look so appealing.
Yeah, it evaporates pretty quickly.
And that's what gives Deere significant pricing power. They don't necessarily have to be the cheapest because the cost of switching is so high. It really is like building your whole city's infrastructure around one specific type of power plug. Switching means replacing way more than just one appliance.
That's a great analogy. So given this powerful moat, is it getting stronger, weaker? It sounds almost unbreachable.
Well, this is where it gets really interesting because the answer is kind of both. It's a dual narrative playing out right now.
How so?
Okay, so against their direct competitors, think C&H Industrial, Case IH, New Holland, AGCO, Massey Ferguson Fence. Deere's moat is arguably widening.
Widening.
Because of their relentless R&D spending, especially on that tech stack, they're collecting more data, making their ecosystem stickier, developing more advanced features. Plus, their sheer market share in North America is dominant, like 53% for big tractors, 60% for combines.
But that gives them scale advantages.
Huge scale advantages in manufacturing, R&D, dealer support, Rivals struggle to match that investment level. So from that angle, stronger.
Okay, but you said both. What's the other side? Where's the weakness?
The other side is this major threat from the right to repair movement. And this isn't just, bad press or a few grumpy customers.
Well, yeah.
No, this is a full-on legal and regulatory assault. It could be potentially a fundamental threat to a key part of their business model. A real tectonic plate shift, not just a ripple.
Wow. Okay, explain that. What are they accused of?
The accusation coming from farmers, independent repair shops, and now regulators like the U.S. Federal Trade Commission and several state attorneys general.
The FTC is involved?
Well, yeah. They filed lawsuits alleging that Deere has essentially created an illegal monopoly over the market for repairing its own equipment.
How?
By doing what? By restricting access to the necessary tools, specifically proprietary diagnostic software, like their system called Service Advisor and Specialized Parts. Without these, farmers and independent mechanics often just can't perform many repairs, especially on newer, more complex machines.
So they're forced to go back to the official Deere dealer.
Exactly, which means dealer labor rates, dealer parts prices. And the argument is that this lack of competition drives up costs and extends downtime for farmers.
Okay, I see the issue. So what happens if Deere loses these lawsuits or is forced by regulation to change?
Well, if they're forced to make that software and those parts widely available, maybe on reasonable terms, it fundamentally undermines the exclusivity and thus the profitability of their dealer network's service operations and their aftermarket parts business.
Which directly hits the switching cost we talked about.
Precisely. If a farmer knows they can get their Deere equipment fixed anywhere by an independent shop, using readily available tools and parts, maybe even cheaper, that makes the dealer relationship less sticky. It lowers switching costs. It erodes Deere's pricing power in the aftermarket.
So the moat is widening technologically against competitors.
Yep.
But potentially narrowing significantly because of this legal and regulatory pressure over repairs.
That's the tension. A really crucial dynamic to watch.
Definitely. Now, you mentioned grumpy customers. Let's pivot to the human element. We've talked strategy, tech, moats. But what about the people actually using these machines? And the people working at Deere? What's the word on the street? The scuttlebutt.
Right, and this is where it gets complex. Again, almost contradictory. If you look at online forums, places where farmers hang out digitally.
Like Green Tractor Talk.
Exactly, that's a huge one. Over 90,000 members, millions of posts. Yeah. You see undeniable, deep-seated loyalty. Real affection for the John Deere brand.
Generational, like you said.
Absolutely. People posting pictures of their grandfather's tractor alongside their brand new one. It's a powerful emotional connection, a massive asset for Deere.
But there's always a but, isn't there?
There is, because those same forums are absolutely filled with intense frustration. And a lot of it centers squarely on this right to repair issue.
So it's not just regulators. Farmers are really feeling it.
Oh, absolutely. You read complaints about software lockouts, stopping them from doing basic maintenance, frustration over what they see as exorbitant dealer service costs, long waits for repairs because dealers are backed up. There's a real sense among some of feeling screwed over, to use their language.
That's strong language.
It is. You see comments like, I think I saw one user quote, "John Deere is rolling in his grave over what his company has become." That shows the depth of feeling. It seems especially sharp for owners of maybe lower-end or older equipment, where the repair costs can feel disproportionate.
So real love for the brand, but real anger over the service and repair situation.
A very sharp contrast. Now, shifting to the employee side.
Yeah, what's the vibe internally?
Well, again, a disconnect. Deere's official careers website naturally paints a picture of this empowering, innovative culture. But if you look at anonymous employee reviews, say on Glassdoor or similar sites,
You get a different story.
you get a starkly different story, especially in recent years. Many employees, particularly those who've been there a while, say the culture has gone very downhill very quickly, maybe since around 2020.
Downhill how?
There's this feeling that the company's being hollowed out, that it's become, quote, just another big corporation focused on stock price, a perceived loss of appreciation for the workforce, the people actually building the machines and developing the tech.
But wait, hasn't Deere been posting record profits recently? That seems like a paradox, record profits, but employees feeling undervalued.
That's exactly the tension. And it's a major source of the low morale. Yes, manufacturing is cyclical, layoffs happen, but employees see these significant layoffs happening during periods of record profitability.
And they connect the dots differently.
They connect the dots and see it as, quote, padding the shareholders' pockets, nothing more. It creates this pseudo gap Management talks about valuing employees, but the actions, like layoffs paired with huge stock buybacks, send a different message.
That erodes trust.
Severely.
Right.
And this highlights a really critical distinction we need to make. There's Deere's brand equity, that powerful, positive, emotional connection people have to the green and yellow tractor. That's still strong, mostly.
Okay.
But then there's its corporate reputation, how people perceive the company's actions regarding repairs, service costs, employee treatment. And that reputation is taking a hit. It's deteriorating.
And the risk is?
The long-term risk is that the damage to the corporate reputation eventually starts to corrode the brand equity itself. If enough farmers feel mistreated, if the best engineers start leaving, that iconic brand could tarnish, making customers more open to looking at the competition.
That's a really significant point. The brand isn't invincible if the company's actions undermine it. Okay, let's talk about the leadership steering the ship through all this. Who's the CEO? And what's their approach?
The CEO is John C. May. He took over in November 2019, so he's been overseeing this recent period of both record profits and rising tensions.
And what's his big focus?
His tenure has really been defined by pushing this smart industrial operating model we talked about earlier. He consistently talks about a long-term vision, being owner-oriented, focusing on unlocking customer economic and sustainable value. That's a key phrase, mainly through these big technology investments.
Investing for the future.
Yes, he frames it that way. He often references Deere's long history, nearly 200 years, and talks about serving customers for the next 200 years. It's about building a multi-generational company powered by tech.
Okay, a long-term view. How does that translate into how they actually spend the company's money? What's their capital allocation strategy look like?
It seems pretty clear and disciplined, actually. Priority number one is reinvesting in the core business. Huge spending on R&D for that tech stack and on capital expenditures for manufacturing. They've even announced plans to invest something like $20 billion in the U.S. over the next 10 years.
$20 billion? That's serious investment.
It is. Second, they do strategic acquisitions. The big one recently was buying the Virgin Group back in 2017 for over $5 billion. That was a logical move, really expanding their construction and forestry business and adding some revenue diversification away from pure agriculture.
Makes sense. And the third piece?
Shareholder returns. They have a consistent policy here. They pay dividends. The payout ratio is actually pretty conservative, around 27% projected for 2025. And they do substantial share repurchases.
Buybacks, yeah. How substantial?
Very. Billions of dollars. The buyback yield was over 6% in 2023, still over 3% in 2024. They bought back, I think, over $800 million in stock in just one recent quarter. So significant cash going back to shareholders.
Okay. Reinvestment, acquisitions, shareholder returns seem standard. But you mentioned that say-do gap earlier.
Right. And this is where the capital allocation, while seemingly rational on paper, hits that cultural tension point.
Yeah.
The scale of those buybacks, especially when they happen at the same time as significant employee layoffs during record profit years.
It sends a message.
It sends a message that, to many employees and some observers, looks like prioritizing short-term financial metrics and shareholder returns over investing in the long-term health of the company's culture and its broader stakeholder relationships. And you can argue that potentially damages the innovation engine long-term if morale tanks a top talent leaves.
A potential unintended consequence. So, putting the tensions aside for a moment, how strong is Deere's financial footing overall? Are the profits solid? How do they hold up in downturns?
Fundamentally, Deere is a highly profitable company. Very reliable, although, as we said, inherently cyclical. They hit that record net income, over $10 billion in fiscal 2023. That's serious money. And historically, they've shown real resilience. They got through the 2008 financial crisis relatively well, bounced back strongly after the initial COVID shock. So yes, a downturn in sales is forecast for fiscal 2025. That's expected in this industry.
Cycle turns.
The cycle turns. But the underlying business and the long-term trends seem positive. Now, to really judge their financial quality, you kind of need to separate the industrial operations, the manufacturing side, from the financial services arm.
Why is that important?
Because the finance arm naturally uses a lot more debt or leverage. Looking at the consolidated numbers can be misleading. If you isolate the industrial ops,
okay, what do you see there?
You see some really strong metrics. Return on invested capital, or ROIC, a key measure of profitability and moat strength, is consistently high. It was over 17% using a proxy in 2023, currently around 9.3%. That signals a really wonderful company, financially speaking.
Generating good returns on its investments.
Excellent returns. Their free cash flow conversion is also strong. They're good at turning accounting profits into actual cash they can use. That's what funds those multi-billion-dollar dividends and buybacks year after year.
Right. Cash is king.
And importantly, the balance sheet for the industrial unit is quite strong. They run with prudent leverage, a debt-to-equity ratio under 10%. That gives them a big cushion, a margin of safety to weather downturns.
So the core manufacturing business is financially solid, even if the overall leverage looks higher because of the financing arm.
Exactly. That higher consolidated leverage, maybe around 2.85 currently, is just a normal feature of having that large captive finance operation. It doesn't signal weakness in the core business.
Okay, good financial health, strong moat, but under pressure, strategic pivot towards tech. Bringing it all together, what's the market verdict right now? Is Deere seen as a good investment at its current price?
Well, the market view seems to be that the current price is, let's call it demanding.
Meaning expensive.
Potentially, yeah. It's trading at a price-to-earnings ratio, the PE, of around 25. Now, compare that to its 5-year average PE, which is closer to 18.
So significantly above average.
Right. And remember, that's happening even as earnings are actually expected to decline in the near term because of the cycle.
So why the high multiple?
Well, the argument, the bull case, is that the market is essentially saying, okay, we see the short-term cyclical dip, but we believe in this long-term transformation.
The smart industrial pivot.
Exactly. The bulls believe Deere is successfully becoming a different kind of company, one with higher margin, recurring software, and data revenue streams. And that kind of business, they argue, deserves a permanently higher valuation multiple than the old, purely cyclical hardware business.
So the market might be pricing in the success of that transformation already.
That's the crux of the debate. Is the current price fair because the company is fundamentally changing for the better? Or is it demanding because it's paying up for future success that isn't guaranteed, especially with earnings falling right now?
A classic investment dilemma. So boiling it down, what's the number one driver for Deere's future growth? And conversely, what's the biggest thing that could truly knock them off course?
The single most important growth engine, I think, has to be the successful execution of that whole solutions as a service strategy. Hitting a 10% recurring revenue target by 2030, proving they can build a durable, high-margin business around precision ag tech. That's the upside story.
Okay, tech execution is key. What about the derailers? What are the really serious long-term risks?
I'd point to 3 genuine risks that could, permanently damage the business, not just cause a temporary dip. Number one, by far, is that regulatory and legal defeat on right to repair.
You really see that as the biggest threat?
I do, because it's the most immediate, and it strikes right at the heart of a very profitable, protected part of their current business, the aftermarket. If they lose decisively, if they're forced to open up software and parts, that could fundamentally reset profitability for a big chunk of their operation. It's a potential game changer.
Okay, right to repair is number one. What else?
Second is that risk of permanent brand and culture erosion we discussed. If they alienate too many loyal customers with repair frustrations, and if employee morale continues to decline, impacting innovation and service, that slowly eats away at their core strengths, their loyalty, their pricing power. It's a slower burn, but still very damaging long term.
Makes sense. And the third?
Third is always technological failure or disruption. Maybe they just fail to execute on their ambitious tech roadmap. Or maybe a competitor, perhaps even a non-traditional one, a tech company comes along and leapfrogs them with a better, cheaper, or more open solution. Less likely maybe given Deere's scale, but always a risk in a tech-driven world.
Right to repair, brand culture erosion, tech disruption.
Got it.
So final question, zooming out. What do you think is the biggest thing the market might be missing or underappreciating about Deere right now? What's the potential blind spot?
Well, thinking about that second level thinking, what the consensus might be missing, I think the market generally sees the near-term ag cycle. Everyone debates how deep the downturn will be, how long it lasts. That's priced in to some extent.
Okay.
And the market also sees right to repair. It's been in the news. But I suspect the consensus view treats it more like a manageable headwind.
Mm-hmm.
Maybe they'll pay a fine, make some concessions, but the core business structure remains intact.
And you think that's wrong?
I think the contrarian view, and the one this analysis leans towards, is that the market might be significantly underestimating the binary nature and the potential magnitude of this right to repair risk.
Binary meaning it's win or lose.
Pretty much. This isn't likely to be a small linear adjustment. If they suffer a major legal defeat, forcing genuine openness, it's more like a pharmaceutical company losing patent protection on its blockbuster drug.
The patent cliff analogy.
Exactly. You don't just see a modest dip in margins. You potentially see a collapse in profitability for that specific segment because suddenly a protected monopoly is thrown open to intense competition.
So the market might be focused on the cyclical waves,
while potentially missing a fundamental shift in the tectonic plates underneath regarding the aftermarket business model. That, I think, could be the biggest blind spot. Underestimating just how disruptive a comprehensive right-to-repair outcome could be for Deere's profitability structure.
Fascinating. We've certainly covered a lot of ground on John Deere today. It really is a company that shows the complexities of modern business, doesn't it?
Absolutely.
We've seen those incredibly deep roots in a fundamental human need, food. We've seen that really impressive moat built on brand loyalty and advanced technology, and this ambitious plan for a future driven by data and software.
But yeah, we've also uncovered these really significant friction points, this powerful right-to-repair movement directly challenging a core part of how they make money, and this clear disconnect between the corporate strategy and how many customers and employees seem to be feeling right now.
That tension really highlights how even the strongest companies, the biggest fortresses, face these pressures, both from the outside and from within.
Internal pressures, too.
So maybe here's a final thought for you, our listener, to chew on. What does it really mean for a company's identity, its soul maybe, when its vision for leading through technology clashes so directly with this public and regulatory pushback over control and access?
Yeah, that's a deep question.
How does a company like Deere ultimately balance generating value for shareholders with maintaining trust among all its stakeholders, customers, employees, the public, especially when that trust is so directly linked to its most valuable assets, the brand itself, and that competitive moat?
It really shows, I think, that understanding a company today means looking way beyond just the financial statements. You have to dig into the operations, the culture, the technology, and how it all interacts with society.
Couldn't agree more. Well, thank you for joining us on this deep dive into John Deere.
My pleasure.
We really hope this gave you a well-rounded, truly informed perspective on a company that, one way or another, shapes the world we live in. Until next time, keep digging deeper.